Good afternoon. This is Tom Alexander. It is Saturday, December 10th. It is about 2:34 p.m. Eastern Time on Saturday afternoon in beautiful Charleston, South Carolina. Okay, here's the bottom line for next week. I think we're going down hard. And I'm going to outline the case why I think that. But before I tell you the case for that, I want to tell you up front what would invalidate my opinion. What would invalidate my opinion is price action, and specifically if all four of the primary U.S. trading indices, the SPX, the NDX, the RUT, the Russell 2000, and the Dow, all close above Friday's highs, then I'm wrong. And we're going to have just as sharp a move to the upside as I think we're going to have to the downside, at least early in the week. Now, next week is also full of drivers for the market that have been the drivers for this market since the beginning of this bear trend back in January. Specifically, we have more economic reports. We have the CPI out on Tuesday. And then most importantly, we have the last Fed meeting of the year. There will be a rate announcement on Wednesday, inevitably higher to one degree or another. They're talking about 50 basis points. That's not as important as what Powell says following that. From a structural perspective, the market is set up to decline very, very sharply. By the way, if you like this video, please subscribe. Please hit like. If you have comments, by all means, please put your comments in the comment section below. If you have questions, put them in the comment section below, or I'll answer every single one of them. And if you have not received the written report that accompanies this video and you want to receive it, send me an email to tom@alexandertrading.com. I'll put you on the list and you'll get it each weekend. Okay, let's take a look at some charts. Okay, I'm going to take each index. And here we are in the SPX. Now, we sort of had this inverted V top here. And then we had a drop, and we've been in balance for the past 4+ days. This is an important low, this spike low on the 17th. But more important is the range of November 10th. And this is November 10th. If you recall, this was the last Fed-induced big move, the ebullience of the market reaction following the perception that they're going to pivot, lower rates, whatever. Well, this range has held so far. Now, if I'm right about this market rolling over and we're going to be down sharply next week, this is the range that I think is going to be retraced. And there is not, quote unquote, support from an auction market perspective until you get down to the low of the 9th. This was the 10th, the low of the 9th right here. So you had the big gap up on the 10th, but it really began at that low on the 9th. Okay, let's go to the NDX. Now the NDX has been, and part of the reason that I believe, and I put this in the report last weekend, part of the reason that I believe we're going lower is because we could not get above the November highs in the NDX or the Russell. Now we traded a few handles above it on the 1st of December. Now we've traded all the way through that range down to the downside. We're knocking on the door of the November lows, bounced off of it here last Wednesday. But below this level, again, you're in an elevator shaft that extends all the way down to the low of the 9th. And I highlighted this in the written report. So this is your level to keep an eye on in the NDX. If we do trade off hard next week, sell off hard next week, I think you'll see this low. Okay, let's look at the Russell. And again, the Russell is another, like the NDX. The Russell has been unable to generate any momentum above the November high. It failed at this attempt, and it's now sort of in the middle of nowhere. It's actually very deeply into that November 9th, November 10th range now. And next week, if the market sells off as I think it is, think it's going to, you're going to test or exceed this level. Last but not least, the Dow. Now, the Dow is the index that has held up the best. The decline so far off of this top has been really shallow. And if you're in a balance area here on a short-term basis, this whole structure is somewhat of a two-sided trade. If we now take out the November lows, you will be deeply into this range similar to the other indices, and really trading to here would still be a relatively benign retracement based on how far the Dow ramped from that mid-October low. So to or through this area is not exactly a bull call. It will be really interesting next week if one or more of the four primary trading indices take out that November 9th low. Then we'll have to take a look at what the others are doing. We'll have to take a look at the technical situation. So it's going to be a really, really, really interesting week. Okay, so speaking of the technical situation, that's another piece of the puzzle here. Let's take a look. Now, the price breadth work that I keep is pretty straightforward, but it gets a little bit more complex when you add in the idea of context. It's the context that's really, really important. And I suggested last week that there were divergences in this work that suggested an important top could be in place. That's still the case, and it continues to be validated by the 10-day and the 5-day moving averages of NYSE advancing issues continuing to roll over, but they're nowhere near a downside extreme. Another reason I think we may have put an important top is the fact that we went almost 2 months without a negative 2000 breadth reading, which was expected. You expect in these rally phases not to see a negative 2000 breadth reading, and we didn't. That was the second longest period of time we've gone not seeing a negative 2000 breadth reading since the January top, exceeded only by a few days by the rally that began mid-June into the top in mid-August. I also said last week, and maybe the week before, that we shouldn't see a negative 2000 breadth reading until the rally was over. And when we saw that, it would be a signal that the rally is over. Well, we got that I think it was Monday. Last Monday, we had a negative 2000 breadth reading. So if you go back and you look at each of these declines, beginning with the January top, you had pretty early in the decline phase, the bear leg, you had a negative 2000 breadth reading. And then what followed that was a succession of negative 2000 breadth readings that became more and more frequent within the respective legs to the downside. So if we have indeed made an important top and we are trading considerably lower to or through the November 9th low, then you're going to see negative 2000 breadth readings, and you'll see a cluster of them, and you'll see more than one. So this is additional evidence on the side of a potential important top forming. Again, what invalidates this? We always use price to validate or invalidate any form of analysis or opinion or assumption that we make when trading. Price is the final arbiter. Price determines whether we make or lose money. I am probably very wrong about a bearish case if all four of the primary U.S. indices close above their respective Friday cash highs. I do think there's going to be an extremely sharp move next week. And if I am wrong that it's down, is probably going to be up, and the sign this up is if all four of the primary U.S. trading indices, the cash indices, trade above that Friday high. But I think it's going to be down. I'm telling you that. That's how I am positioned. I will have to reposition if the Friday highs are taken out. Now, let's look at this view, and I've been putting this in the report for several weeks. This is the S&P SPX on the top, and this is VIX below. Every time since the January top, we have declined into negative 20 or lower, 20 or lower, positive 20 or lower VIX. We've been near a top. That occurred at the top in January. It occurred at the top in March. It occurred at the top in August, and it's occurring, or appears to be occurring, at the top, most recent top. The other thing that has occurred was that you began to see VIX pick up following the highs in the beginning of the decline. Now, if it's different this time, then we're going to turn around. VIX is going to drop again below 20. And if that happens, then again, I'm probably wrong and the thing's going to rip higher. And I will then have to reposition myself to the long side of this market. But this is evidence. If this pattern plays out, then we could have some really hard selling, similar to what we saw in the legs down that have occurred since the January top. Breadth is supportive of this, structure is supportive of this, and VIX is supportive of this. Now, as I put in the report, I've been trading for 38 years. My biggest losses as a trader have always occurred when I felt like I had irrefutable, positive evidence that something was going to happen, and I turned that something was going to happen into had to happen. This doesn't have to happen. And I'm talking to myself now and with you. So if it doesn't, we have to know what it is, and we have to be willing and flexible enough to get out of any short position we may have, and if facile enough to get into long positions. But everything that I see as I'm writing this report and doing this work on Saturday, and I've been working on it all day long, suggests that we're moving sharply lower. I do really, really believe we're going to move sharply one way or the other, perhaps in more than one direction by the end of the week. But we certainly have the exogenous catalyst with the CPI out on Tuesday. We have Powell on Wednesday. So stay tuned. I hope you found value in this. And again, I would very much appreciate it if you'd like the video, if you would subscribe to the video, and by all means, please leave your comments. I'll be happy to respond to any questions. You guys have a wonderful week. I'll speak with you soon.